Good morning. It's Wednesday, the 29th of January, and the month of January is ending. And this is Govindraj Ethiraj, headquartered and broadcasting and streaming as always from Mumbai, India's financial capital. Our quick take for the day. India and China have agreed to resume direct air services after nearly 5 years and agreed also to work on resolving differences over trade and economic issues, according to an official statement from India. Now, this follows meetings between India and China's top diplomats and is largely seen as further improving a relationship which had deteriorated considerably following clashes on the border 5 years ago. The meetings were obviously scheduled before the DeepSeek bomb dropped on Silicon Valley on Monday. But this is serendipitous nevertheless. China has demonstrated its artificial intelligence chops in a manner that's obviously shaken up the global tech universe and battered most stocks, with chip giant Nvidia facing the worst of it in a manner perhaps quite never seen before. More specifically, Nvidia lost about $600 billion in market capitalization on Monday, the biggest drop for any company on a single day in US history. Nvidia had surpassed Apple to become the most valuable publicly traded company, and that sell-off, as we've been discussing, was driven by fears that DeepSeek, the Chinese AI alternative, was much cheaper and consumed far less computing power, which in turn translates into more chips and more energy. Now, viewed in the context of America's tariff threats and trade war cries, this is an interesting moment. A foreign policy analyst told Reuters that economic headwinds are being faced by both India and China, and both have an interest in ensuring the economic relationship continues to be managed in a mutually beneficial way. Bilateral trade between India and China rose 4% to about $118 billion in the last fiscal year that's ended March 2024, and most of it has been Indian imports from China, which has been rising in recent years. How this will shape up and evolve, it's a little early to say, but these combined developments, one is of China demonstrating its new AI and technology chops, the second, India and China warming up once again, and third, of course, both India and China facing the United States in what looks like is going to be a start of a trade war, is obviously an interesting new dynamic. And now the top stories and themes. The Indian markets recover on Tuesday as banking stocks lead. Understanding the central bank's liquidity boost measures, what caused the problem and now the solution. Oil prices edge up as action in the high seas in this part of the world continues. Colombian coffee prices are hitting record highs. More news from the Trump tariff tracker. And what is determining prices of gold right now?
This is a call report with Govindraj Ethiraj.
The markets rally. The stock market staged another relief rally, a term that best explains the kind of recovery we saw on Tuesday. It's useful to look at the overall data on where the markets are right now in case you're trying to form an opinion on whether this is a good time to invest. But before that, on Tuesday, the Sensex was up about 535 points to close at 75,901. The NSE Nifty 50 was up 128 points to close at 22,957. The markets did see some swings, though not as wild as some other days. The broader markets were down, though, with the Nifty Midcap 100 and Nifty Small Cap 100 indices closing down about 0.5% and 1.8%, respectively. One reason for the markets doing well on Tuesday were banking stocks, who in turn were relishing a liquidity boost in the system, and more on that shortly. And now here are some of those macro data points via Reuters. The Nifty 50 and Sensex have lost about 3% each in January, the second most in a 4-month losing run. They've now fallen about 12.6 or close to 13% and close to 12% respectively from their record highs on September 27, 2024. A key reason for this continuing fall and weakness is obviously foreign portfolio investors who've pulled out about $8.3 billion from Indian equities this month. And that figure is now inching towards the record $11 billion of outflows in October last year, that's 2024. And the small caps are now entering bear territory. They've fallen nearly 19% from their record highs hit in December 24, and the mid caps have dropped 15.5% from their all-time high. Incidentally, just to go back to Tuesday, stock prices of artificial intelligence-driven electronics manufacturing services firms like Dixon Technologies, Keynes Technologies, NetWeb, and MIC or Mike Electronics fell, according to a compilation in Money Control. And this is obviously because of the Nvidia effect flowing into these stocks, though that Nvidia effect was not felt elsewhere, like it was not really felt even in the United States particularly amongst the other broader indices like Dow Jones and S&P 500. Meanwhile, Wall Street was steady overnight following that massive sell-off on Tuesday. Futures for the major indices, including Nasdaq 100, were edging into positive territory. Understanding the liquidity boost. Banking stocks stole the show in many ways on Tuesday, with the Nifty Bank, the public sector bank, and private bank indices all up higher by more than 1%. The stocks gained after the Reserve Bank of India on Monday announced a three-pronged measure to address tight liquidity conditions in the banking system, just 10 days before a monetary policy decision on the repo rate. These steps, according to bankers, are expected to inject about 1.5 trillion rupees or 150,000 crore rupees into the system. Now, data shows the banking system's liquidity deficit, measured by the Reserve Bank of India's Liquidity Adjustment Facility, or LAF, stood at about 313,000 crores last week, with the deficit constantly exceeding 300,000 crores in the last 4 days, that's last week, except for Friday. Now, experts told Business Standard that the Reserve Bank has front-loaded the liquidity infusion ahead of a possible rate cut to help monetary transmission. Now, the measures have definitely lifted financials higher, as easing liquidity could support credit growth and earnings of banks and non-bank lenders, according to analysts who spoke to Business Standard. I reached out to Madhavi, Arora, chief economist at Emkay Global Financial Services, and I began by asking her to take us through why there was a liquidity squeeze to start with and whether and how the present response would help.
Conventionally, you do see a fourth quarter of fiscal year having a liquidity crunch. You generally have a much higher currency leakage, generally have much higher tax outflows, payouts will be much higher. Generally, the fourth quarter is more tax heavy. These two factors anyway play a major role in tightening of liquidity in the fourth quarter generally. Now, this year, the only difference that has worsened the liquidity condition is two factors. One is the government spending, which has been less robust, which basically meant that whatever taxes that they collected have not been spent. So the money is stuck with the government's balances with the Reserve Bank. And the second one is the FX intervention of the RBI, which either happened in spot or in the forward market. But irrespective, if there's an intervention, somewhere the liquidity impact would be felt, if not today, but tomorrow. So I think these two factors, which is tepid government spending and extremely high intervention by the RBI in the fourth quarter, which has also continued to some extent in this month also, but much less in terms of the way they were doing earlier. But of course, the kind of outflows that you're seeing has implied that policymakers had to sort of support the currency to some extent. But clearly, these two factors have been the biggest mover for liquidity deficit to have worsened. Just to recall, RBI had done CRR cut in early December, which had infused 1 lakh crore worth of liquidity in the month of December with 2 tranches. That also hasn't helped. So since, I think, late December, third week of December or so, we have been seeing consistent liquidity deficit to the extent that at this point in time, we were close to around 3 lakh crore when the RBI announced the new measures, which essentially will imply permanent and some semi-permanent liquidity infusion of close to around 1.5 lakh crore.
And if you were to look a little ahead now, the Reserve Bank has 2 or 3 methods by which it introduces liquidity. So if you could just take us through those measures and how it will help. And the larger question being, how will this liquidity or easing of liquidity help the economy?
So the way for them to generate additional liquidities is basically 2 or 3 ways, which is what they had sort of done as well. So they could be, temporary liquidity infusion, which by, say, they are lending to the banks, right, which is the repo operations. So they could do variable repo operations of 1 week, 2 weeks, 3 weeks, or maybe 3 months, depending on how they are viewing the problem of liquidity. It's a temporary measure. Eventually, banks will have to reverse that, right? It's a reversible operation. So basically, it's a temporary measure to infuse liquidity for a certain period of time. Then they can always do something which expands their balance sheet, which is the open market operation, right? When they start buying government securities, when they do that, their own base money creation increases or the balance sheet of RBI increases, which infuses durable liquidity in the system, durable rupee liquidity in the system. The second way, and of course, other ways being, again, temporary measure like FX swaps. They can basically do dollar rupee swaps, which leads to dollar liquidity being sunk down, rupee liquidity being injected in. That also can be a temporary measure depending on the tenure of the swap. This time they had done a much shorter swap, but they can always do a 2-year, 3-year also for that matter. So that depends on the way they want to keep liquidity high, and they can always do something like a CRR cut, which again infuses permanent liquidity to the extent of, say, if they're reducing CRR by 0.5% of HDTL. So to the extent of the deposit base, 0.5% of liquidity will be available to the system because banks would not be required to keep a high CRR or cash reserve ratio, as they say.
Right. And that obviously brings us to the next logical question, which is that are you seeing that cut soon? And that's one. And the second is there any other signal that you're seeing that is being transmitted because of what all this action with the Reserve Bank responding, though it is usual at this time of the year, but you said there were a couple of factors which are a little unusual, including government holding back. So what are any other signals that we should be watching out for?
So I think, see, last quarter was a very interesting quarter for you to assess the RBI's reaction function. We saw massive emerging market currency pressures, which were not necessarily rupee targeted, but generally there was a pressure on emerging market currencies because dollar was strengthening, owing to factors which were again not led by emerging market, but owing to what is happening in the US economy, be it in rates point of view or be it the fact that the growth is exceptionally strong in US versus its developed peers. So US was enjoying that dollar bull run, which impacted other emerging currencies. And RBI, I think, went way too ahead to defend the rupee when there was no problem from the rupee's point of view. When there was no attack on the currency, you went all out to defend your currency, while you could have probably been much more judicious in your arsenal of or your spending pattern of FX. Because if I just give you a number reference, as per my estimate, the balance of payment, which is basically a difference between your trade deficit and your FPI flows and other venues of capital account, which could be FDI or ECB and stuff. So the net balance of payment of the economy for the third quarter of fiscal, which is December quarter, in my estimate was somewhere around deficit of 25-30 billion maximum, which means that the economy was having a fundamental problem of around 30 billion or 25 billion of dollar deficit. So to the extent of that, if the RBI had intervened, I would have understood, they're trying to actually save the economy from the volatility and the fundamental problems. What they ended up doing was making the rupee extremely flat on volatility. There was literally zero walls. It's like RBI is really looking to tap a particular target. More so, we became extremely overvalued against our peers. So to the extent that in the fourth quarter of CY24, which is December quarter, we were actually 2% up against CNY because we were the only currency in emerging market which was stable or appreciating, while everybody else was, going through their own troubles because of dollar strength. And RBI, to the extent of the BOP deficit of 25-30 billion, ended up spending more than 110 billion on intervention-led FX, which was around 20% of their own FX kitty. So you don't spend your arsenal at a time when there is no attack on you per se. It was generic attack or generic depreciation that was happening. So what happened owing to that is that RBI, we were made to believe that our RBI is really, or the policymakers in general, are looking to really keep rupee overvalued. And there's either they are obsessed with the fact that a strong rupee is a reflection of a strong growth in the economy or strong economy in general to the global investors or whatever the case may be. But clearly they went overboard with whatever they did, which also made us believe that RBI, having being obsessed with the rupee management, probably will not be able to cut rate in February because any kind of rate cut technically in economic parlance would probably lead to a much lower interest differential or the risk differential or risk premia that emerging markets should offer to the FPIs. And thus there could be a further depreciation pressure on the rupee and RBI would be wary of that, which made sense. And thus in December, they actually did TRR cut instead of any kind of repo cut because that's the more unconventional way liquidity infusion that they can do would not necessarily lead to big headlines in terms of repo rate cut and then probably rupee. This is the least painful measure that one can think of. The fear was that if the dollar appreciation continues in the next quarter, February will also be a very difficult call to take because one would not know how Trump administration would actually behave. Luckily for the global markets, the Trump rhetoric has sort of faded to some extent, that dollar rally has also faded, which has given some wiggle room or relief room to the emerging markets to the extent that country like Indonesia, which have very high debt exposure of FPI, they have 15 to 18% of the debt which is owned by the foreign investors, have decided to cut rates and not at the cost of their own currency, IDR, and at the cost of other things, but they focused on growth instead of focusing on a higher interest differential. So I think if in the current junction, if the currency volatility sort of remains manageable, they may also opt to cut rates. And if they had to do a rate cut, if they're planning to even think of a rate cut in February, it is very important that they create an environment domestically which is able to absorb the rate cut. When does it happen? When there is a decent liquidity in the system. If you have a deficit of around 3 lakh crore, 4 lakh crore in the system, rate cut would be a waste cut. So then that's what they have tried to address So that was partly a signaling tool also that one, there's a rupee pressure which is manageable. We've let the rupee fall. We've decided maybe partly that, we'll not focus on the rupee, but we focus on, say, monetary policy management and let the SPI be. So to be very honest, India is not a debt or interest differential economy. FI has come to India for growth. If you have a growth differential with the rest of the world, people will anyway come to India and the rupee will take care of itself. So I think to some extent they're trying to address those things. And my sense is that if at all there is no disruption in the global markets, February should see a rate cut. And we may also see further unconventional easing ways for the RBIs to probably bring in more countercyclical measures to the economy, which could be either in the form of more liquidity infusion at the margin here and there, or in the form of probably easing lending conditions in the economy by probably easing the conditional norms on the banks with regard to the provisioning to, say, NBFCs or infra lending and stuff like that they had discussed or they had implemented last year.
Right, Madhavi. Thank you so much for joining me.
Thank you, guys. Bye.
Oil prices ease off. There is considerable action quite literally in the high seas now as sanctions on Russian oil kick in. Reuters is reporting that trade for March loading Russian oil in top buyer Asia has stalled thanks to a wide price gap between buyers and sellers, which has emerged in China after costs for chartering tankers unaffected by the US sanctions has increased. Sanctions by America over 2 weeks ago targeted Russia's oil supply chain, causing tanker freight rates to soar as some buyers and ports in China and India steered clear of those sanctioned ships. So those latest sanctioned target tankers or sanctioned ships carry about 42% of Russia's seaborne oil exports. Most of that goes to China, according to analytics firm Kepler, though sanctioned tankers are gradually discharging oil in China and India during the waiver period on right now, according to Reuters. The US had earlier clarified to India that tankers loaded with Russian oil must discharge by February 27th under the sanctions, according to Indian government officials, and payments for oil on board ships must be cleared by March 12th. On Monday, China also reported an unexpected contraction in January manufacturing activity, further fueling concerns over a slowdown in crude demand growth. Meanwhile, though oil prices have edged higher, they've still remained cooled off and are now near a 2-week low as of Tuesday, thanks to that weak economic data from China. Another factor that's playing on oil prices is rising temperatures, which is obviously lowering potential demand for heating. Brent crude oil futures were at about $77.43 per barrel on Tuesday, so therefore under $78 a barrel. This segment was supported by the India Energy Week 2025, scheduled from February 11th to 14th in New Delhi, and you can register for the same using the link in the show notes. Tracking Trump tariffs. So we are back to our favorite segment on Trump tariffs. The United States will impose tariffs on countries that harm America, President Donald Trump has said, naming India, China, and Brazil as examples of high tariff nations. Speaking to House Republicans at a retreat in Florida, he said that we're going to put tariffs on outside countries and outside people that really mean harm to us. He also said he would impose tariffs on aluminum and copper, metals that are needed to produce US military hardware, as well as steel, to entice producers to make them in the United States. And he said that we have to bring production back to our country. It was not clear how broadly these tariffs could be applied, but several mining CEOs quoted by Reuters have previously said that they're preparing for different scenarios as markets brace for a potential change to trade flows. Analysts also pointed out that US aluminum and copper smelters have been closing and would need new infrastructure and power contracts to restart, among other measures, all of which will take time. Arabica prices rise. Remember Colombian coffee? Well, it's quite likely that you might hear a little more about it now. Colombia is a key source for high-quality Arabica coffee beans, and Colombian coffee usually means Arabica beans grown there. So the United States imports about 30% of its coffee from Colombia, along with other food staples such as bananas and avocados and gold, according to JP Morgan analysts quoted by Reuters. Overall, the US imported about $16 billion in goods from Colombia in 2023, according to Census Bureau data. Now, the reason we're talking about it, continuous Arabica coffee futures were up about $3.50 a pound in evening trade in Europe on Tuesday. But more importantly, they're up about 40% over the past 3 months and almost 80% on year. Before November's rally, coffee prices had generally been supported by developments in the market for Robusta coffee beans, an Arabica alternative, thanks to hot and dry weather in Vietnam, which sharply lowered production. Trump had earlier issued threats to impose 25% tariffs and sanctions on Colombia in retaliation for the Colombian government refusing to allow two military planes with migrants to land there. All of this cooled off later, with Colombia saying that they had agreed to Trump's terms. Where are gold prices headed? Current news is that gold prices are holding steady on Tuesday, a day after a sharp decline thanks to that tech-led sell-off. Spot gold was about $2,742 per ounce, having fallen over 1% on Monday, marking its steepest drop since December 18th. Investors had rushed to liquidate bullion to offset losses triggered by that pullback in technology stocks spurred by DeepSeek's low-cost, low-power AI model, according to Reuters. So investors are now looking at the Federal Reserve's first meeting this year, scheduled to start later on Tuesday. Meanwhile, what are the forces of demand and supply at work in determining gold prices across the world right now? So I reached out to Praveen Singh, Senior Fundamental Research Analyst and for Commodities and Currencies at Mirae Asset Sharekhan, and I asked him to take us through the various global factors that were driving gold prices now, and obviously that includes Trump's role in it.
Definitely, there's a lot of volatility and a lot of cross currents, a lot of views and news pertain gold prices. At the same time, people are having different notions about where could possibly gold prices go, especially in the wake of Mr. Trump's election as president. Overall, the way I see the things, it goes like this. In January, gold has risen very sharply. It is up approximately 5% this year. That is despite the fact that actually US yields are somewhat elevated and dollar is mostly flat. So what we are seeing presently in gold is January impact. That is because of the fund flows and expectations of the fund managers regarding the performance of gold in the remaining part of the year. Now, as Mr. Trump threatens major economies with tariffs, he is trying to be focused on growth, and at the same time, he is pursuing his deportation agenda. So these things are definitely going to have impact not only on gold market, but as such on other financial markets as well. Tariff, I don't think that tariff would actually be inflationary. Impact of tariff would be in some other terms. It is going to have a negative impact on global trade. So that will be positive. However, his deportation drive, that would be inflationary because of upward pressure on wage. But at the same time, it is going to constrain the level market. So yields can go up. That would be pushing dollar index upward. And as risk sentiments remain strong and Mr. Trump is focused on growth, so there would be actually increase in borrowings. Borrowings rise, that again would be pushing the yields higher, at least in near term, more so because the job market is strong. The federal leader currently focused on containing inflationary pressure. So it is likely to maintain its hawkish stance. As the dollar index rises because of a rise in yields and because of the risk aversion, initially we can see some correction in gold prices from the current level. But overall, the same thing is likely to become positive for gold going forward because the fundamental drivers for gold remain very well in place, like concerns about the global debt, concerns about US debt, fiscal situation in leading economies. And if I talk about the interest rate payment to be done by the US, that is approaching $1 trillion, a debt to GDP ratio is 100%, and it is likely to rise 120% in a decade or so. So the fiscal scenario doesn't look good. So that is actually a huge concern for investors as well as for institutions also. So that will be supportive for gold. And it is a situation not only in the US, it is being seen elsewhere also, like what happened in case of UK because of borrowing concerns. The cost actually shot up and pound fell to more than a year low. So more or less the same thing happened in France also. So we are seeing that bond vigilance, they are becoming active and there could be a re-rating of sovereign bonds. So in that case, initially gold may go down because of higher yields, but as we know that gold now it does not respond much to its traditional drivers like yields and dollars because borrowing is huge. So the market is saying that if you want to borrow, you'll have to pay me higher cost. And it means that earlier, the kind of impact that we were seeing on gold prices due to drivers like gold and yields, that is not happening anymore. Then we have got big concerns coming from Chinese economy. Like we saw yesterday only that PMI manufacturing has took back into contraction zone and property market is still struggling. So that is yet another thoughts of gold buying. And then central banks, they would continue to basically buy gold to hedge against economic uncertainty as well as to reduce the dependence on the US dollar index. So we have seen very strong central bank buying in the last 3 years, and the trend is more or less going to continue in 2025 also. That is one of the most important sources or gold prices, which is actually leading to buoyancy in gold. And then apart, see the point is that the last 4 years we have seen ETF outflows. So the investment demand as such is not strong. I think it is going to be revived because of the fact that now the markets are increasingly worried about the fiscal situation, including economies like US. Like if I talk about 2020, I think there the investment in that year, the investment demand was around 1795 tons, and the ETF inflow was around 900 tons, I guess. And in the last 4 years, the inflows have been negative. So even if there is somewhat slack left by somewhat reduced central bank buying, we are likely to see investment demand picking up that slack. And in fact, if prices to the tune of what we had seen in 2020, it would be extremely bullish for gold prices. So overall, in short, because of Mr. Trump and his policy, because of risk aversion, higher yields and dollar index, gold prices may go down. But if that happens, so that would be a very good buying opportunity.
Right. Thank you so much for joining us.
My pleasure. Thanks a lot for having me.
That was the Core Report with me, Govindraj Ethiraj. Do stay connected with more of our coverage at the Core. You can check out our website or sign up to our newsletter for our exclusive stories, one in-depth feature a day on www.thecore.in. Do also track us on LinkedIn, where we usually post synopses or extracts of our top stories and interviews. We would love your feedback on how we can make business more interesting and relevant, including, of course, India's vibrant manufacturing sector. So write to us at feedback@thecore.in. And thank you once again for listening.